Have you ever thought about what truly keeps powerful corporations accountable? Who ensures that management doesn't manipulate financial results, or that shareholders' interests are protected even when billions are at stake? That invisible system, that compass guiding every ethical, strategic, and financial decision, is called corporate governance. Corporate governance is not just a compliance exercise. It's the soul of a company's accountability system. It defines who makes decisions, how they are made, how they are monitored, and how those decisions impact everyone, from shareholders and employees to customers and society at large. Welcome back to Audit Decoded by Mayuri, the channel where we simplify complex auditing, risk, and governance concepts into meaningful insights. In today's deep dive episode, we'll explore corporate governance from the ground up, what it truly means, how it evolved, why it matters, and how global frameworks like OECD, COSO, SOX, King of Four, and UK Corporate Governance Code shape the way organizations are managed worldwide. So grab your notepad, because we're decoding one of the most powerful foundations of ethical business, corporate governance. Understanding corporate governance. At its core, corporate governance is a system of direction and control that defines the relationship between a company's management, board of directors, shareholders, and other stakeholders. It ensures that the company operates responsibly, efficiently, and transparently, in the best interests of those who invest in it and depend on it. Governance answers three fundamental questions. Who holds power? The board, management, or shareholders? How is power exercised? Through policies, committees, and decision-making processes. Who ensures accountability? Through internal controls, audits, and regulatory oversight. Good corporate governance transforms an organization from a profit-driven entity into a sustainably managed enterprise that balances performance with purpose. Evolution of corporate governance. Corporate governance as a discipline evolved through corporate scandals and market collapses that exposed weak oversight and unethical leadership. In the early 20th century, businesses were largely family-controlled, and shareholder rights were minimal. The 1970s and 1980s saw major governance failures like the Lockheed bribery scandal, prompting governments to regulate board accountability. The 1990s witnessed the rise of governance codes such as the Cadbury Report, UK 1992, emphasizing transparency and board independence. The 2000s saw corporate disasters like Enron, WorldCom, and Satyam, leading to the Sarbanes-Oxley Act, SOX, and renewed focus on internal controls. Today, ESG, environmental, social, and governance, factors have redefined governance beyond compliance, linking it with sustainability, ethics, and digital risk oversight. Corporate governance has transformed from being a reactive regulation to a proactive culture, one that builds trust, resilience, and credibility in an interconnected world. Why corporate governance matters. Corporate governance is essential not only to prevent fraud, but also to build investor confidence, ensure long-term sustainability, and protect reputation. Weak governance can destroy decades of progress. Just look at Enron, 2001, manipulated financial statements, destroyed shareholder wealth, and led to the bankruptcy of one of the world's biggest energy companies. Satyam, 2009, India's biggest accounting scandal, exposing falsified revenues and weak board oversight. Wirecard, 2020, missing $1.9 billion showed how lack of independent board control can cripple global trust in markets. Each of these scandals forced governments and organizations to strengthen internal control, enhance disclosure, and create a culture of accountability, not just compliance. For auditors and consultants like us, governance is a signal. A strong governance culture often translates into reliable controls, ethical leadership, and reduced fraud risk. Core pillars of corporate governance. Every governance system, whether based on the OECD or King of Four framework, rests on four fundamental pillars. Accountability. The board and management are accountable to shareholders and must justify decisions and actions. Clear lines of authority ensure decisions can be traced back to responsible individuals. Transparency. Organizations must disclose accurate, timely, and complete information, financial or non-financial. Transparency fosters trust among investors, regulators, and the public. Fairness. Every stakeholder, from major shareholders to employees and vendors, must be treated with equality and respect. Fair treatment ensures that minority interests are not suppressed. Responsibility. Management must act responsibly toward both the company and society, ensuring ethical behavior and environmental care while pursuing profitability. These principles build a culture of integrity and trust, where decisions are not just profitable, but principled. Structure of corporate governance. An effective governance system operates through layers of checks and balances. Shareholders own the company and elect the board of directors. Board of directors provide strategic guidance, oversee management, and safeguard stakeholder interests. Management execute strategies and report to the board. Board committees. Specialized teams like the Audit, Risk, and Remuneration committees handle focused oversight areas. Internal and external auditors provide independent assurance on financial and operational integrity. Regulators ensure compliance with laws, codes, and stock exchange requirements. This structure minimizes concentration of power and ensures a balance between authority and accountability. Corporate governance frameworks, in-depth analysis. There is no single universal framework. Each region and industry follows a governance model suited to its regulatory, cultural, and economic context. Let's decode the major frameworks shaping modern governance. 1. OECD Principles of Corporate Governance. The OECD principles, developed with G20 collaboration, serve as the global benchmark for governance. They guide policymakers and corporations in building transparent, fair, and resilient markets. Their 6 pillars include effective governance framework and rule of law, shareholder rights and equitable treatment, institutional investors' responsibilities, stakeholder relations and corporate social responsibility, disclosure and transparency across all operations, the board's accountability for strategy and performance. These principles emphasize long-term sustainability, not just quarterly profits. Many nations model their own governance codes based on OECD's philosophy. 2. COSO Internal Control, Integrated Framework. Developed by the Committee of Sponsoring Organizations, COSO, this framework provides a structure for designing, implementing, and maintaining internal controls. Its 5 components: control environment, risk assessment, control activities, information and communication, and monitoring, form the backbone of both governance and risk management. COSO ensures that management acts ethically, risks are identified early, and information flows seamlessly across the organization. It's also foundational to SOX compliance and ITGC, IT General Controls, linking governance directly with audit reliability. Recently, COSO extended its framework to sustainability reporting, reflecting how governance now includes climate and ESG disclosures. 3. Sarbanes-Oxley Act, SOX, U.S. regulation. The SOX Act of 2002 is a landmark U.S. legislation that revolutionized corporate governance after the Enron and WorldCom scandals. Key highlights include Section 302, CEO and CFO certification of financial accuracy. Section 404, management and auditors must assess and report on internal control effectiveness. Section 409, real-time disclosure of material changes. Auditor independence, prohibits conflicts of interest and non-audit services for audit clients. SOX introduced personal liability for executives, transforming governance from theory to law. Today, SOX compliance is a global best practice even beyond the U.S., forming a cornerstone for internal audit programs. 4. UK Corporate Governance Code. The UK Code, built on the comply or explain principle, provides flexibility while ensuring accountability. It requires companies to either follow its provisions or publicly explain deviations, thereby maintaining transparency. Key focus areas include board effectiveness and composition, diversity, independence, succession planning. Remuneration, transparency linked to performance. Audit and risk management responsibilities. Stakeholder engagement for sustainable business. The 2025 update emphasizes internal control reporting, requiring boards to confirm that financial and operational controls are effective, aligning closely with global best practices like SOX. 5. King 4 Report, South Africa. The King 4 Report is one of the most comprehensive and progressive governance frameworks globally. It emphasizes apply and explain, meaning every principle should be applied with a clear rationale. King 4 introduces 4 governance outcomes: ethical culture, good performance, effective control, legitimacy. It encourages integrated thinking, linking financial results with social and environmental impact. King 4 is particularly admired for merging governance with sustainability and stakeholder inclusivity, a model increasingly adopted across the globe. 6. ISO 37000, 2021, Governance of Organizations. ISO 37000 provides universal guidance on the governance of all types of organizations, public, private, and non-profit. It aligns with existing frameworks, but provides a standardized approach focusing on purpose, value generation, and accountability. It's gaining traction among multinational corporations as a benchmark for governance maturity. Implementing corporate governance in practice. Strong governance doesn't happen by accident. It's the result of conscious design and consistent enforcement. Implementation involves establishing a board charter defining roles and responsibilities, creating board committees for audit, risk, and remuneration, conducting annual governance audits and board evaluations, implementing whistleblower mechanisms for ethical reporting, integrating governance KPIs into performance management, regular training and awareness programs for board members. Governance also depends heavily on tone at the top. The ethical behavior modeled by senior leaders sets the standard for the entire organization. Emerging trends in governance. Corporate governance is evolving rapidly. The modern boardroom now oversees not only financial performance, but also non-financial dimensions like cybersecurity and data privacy oversight, AI ethics and algorithmic accountability, climate governance and ESG integration, diversity, equity, and inclusion, DEI, stakeholder capitalism. The future of governance is integrated, data-driven, and transparent, powered by technology but grounded in ethics. From an auditor's viewpoint, governance quality directly influences control effectiveness. A strong board, independent audit committee, and transparent reporting environment significantly reduce audit risk. Auditors assess governance during risk assessments, SOX testing, and ITGC reviews, looking for signs of management override of controls, lack of segregation of duties, weak tone at the top, poor communication between management and board. In essence, good governance is the foundation of reliable auditing. The two reinforce each other. Corporate governance is far more than board meetings and annual disclosures. It's the ethical DNA of every organization. Frameworks like OECD, COSO, SOX, King 4, and ISO 37000 don't just exist to satisfy regulators. They exist to build trust. Trust in markets, in management, and in the integrity of corporate reporting. Strong governance fosters sustainability, investor confidence, and long-term success. Weak governance, on the other hand, can undo everything: reputation, revenue, and respect. As auditors, consultants, or risk professionals, our role is not just to evaluate controls, but to promote governance excellence, ensuring transparency, fairness, and accountability at every level. So remember, governance isn't a document. It's a daily discipline. It's the invisible force that transforms businesses from profit machines into purpose-driven institutions. Thank you for watching Audit Decoded by Mayuri, your go-to destination for simplified, practical insights on auditing, IT risk, and governance. If you found this deep dive valuable, please like the video, subscribe to the channel, and share it with your peers in audit and risk management. Your support helps us bring more high-quality, knowledge-rich content for audit and compliance professionals across the world. Until next time, stay informed, stay ethical, and keep decoding the world of audits with me, Mayuri.